Katerina, you're gonna let us know, right? Or not?
Yeah. It takes a few minutes to connect.
It's our first try on LinkedIn, which apparently makes it really hard for you to stream online.
Okay, we are live, so you can start.
Hello, everybody. Welcome. Let's give us a couple of minutes so everybody can join. Not. So I think we can wait just a minute so everyone can join. So okay, I think we can start. I hope we're live. I don't see that in my LinkedIn feed, but I hope we're live. But all this effort doesn't go to waste. Well, I'm Panagiotis, and I'm the managing director of Endeavor Greece. And I would like to just a minute of introduction, then I'm going to let Marco take the conversation and what the panel has prepared. We love disruptive things, right? And we love to see things that change industries or change behaviors. And we like to think that we in Endeavor we work with these entrepreneurs, right? And we have the entrepreneurs that are the disruptors and also bring these changes. So this is a natural place for us. And when we watched Gamestop, we thought that this is something that it's interesting to see what our entrepreneurs think. And in all fairness, we lost a lot of money. So we thought of, no, I'm kidding, of course, we didn't lose any money, but I thought, who better to describe this situation and help us go through what's changing or not in retail trading from people entrepreneurs who are in wealth management, right? In case someone made or lost a lot of money. Before jumping into the conversation, I would like to say that this is part of our. I think this is an international panel, and it's an interesting one. Endeavor Greece is doing a lot of work in thought leadership, and we've seen a lot of people joining into our platform. So the latest thing that we've launched, and we're trying to promote this narrative of that Greece and Athens can be the hub and are on the cusp of a major transformation for the next years. And we've launched a new platform. People who join our thought leadership and join our events. Now, you can log into workintech.gr, and if you are inspired and if you're impressed by some companies of our portfolio, you can let us know with a simple questions, a simple registration form, and we will connect you with the companies in our portfolio. It's meant to bridge the gap between our portfolio and the people who join our events, which were in the thousands last year, and we will continue growing this number. And with that, I'm going to pass the baton to Marco Veremis. Marco is a partner at Evanston Capital, and he used to be at Cambridge Associates, and he's very much involved with fintech and crypto. And he's perhaps the first person from our side, at least, to manage this conversation, because I'm going to be lost in the very first minute. So, Marco, thank you.
Thank you, Panagiotis. Thank you very much. Thanks, everyone. So we have a fascinating topic, as you know, to discuss here today, and we have a group of distinguished speakers in the fintech space to share their thoughts about it. But before I introduce the speakers, I think give me 1 or 2 minutes to describe what happened with the GameStop events for those who are not aware, and what are some of the broad topics and questions that these events raised. So let me start with what happened. So here's what happened. In January, a Reddit group of retail traders called Wall Street Bets worked to push the price up of some heavily shorted stocks like GameStop. GameStop is just one of these stocks. It's a brick and mortar video game retailer with bad fundamentals, and it was highly shorted by hedge funds. Now, the retail traders knew that if they started buying this stock, it would create an upwards price move, and it would force buying by hedge funds and other institutional players to cover short and options positions as losses on paper for them mounted and they received margin calls, creating an upward spiral in the stock prices. GameStop was one of them, as I said, and to get a sense of how violent this upward move was, the stock went from $18 a share to around $350 a share in a period of less than 20 days in January. A trader called Deep Effing Value turned 54,000 reportedly into 48 million paper profits during this period. Just to see, these anonymous traders on Reddit, were making substantial gains, at least on paper. Now, the upward squeeze caused massive losses, as I mentioned, for numerous hedge funds, including one famous one called Melvin, which was down 50%. And the other important thing I should mention is that the retail traders used fintech services, and we'll get into the fintech aspect of this, like Robinhood, to trade efficiently and at no cost for both stocks as well as options. Now, these events opened up several debates, and I will mention two here, and the speakers will have many more thoughts around these. The first debate is of a more philosophical nature, and the second debate is of more of a technical nature related to fintech. But what is the philosophical debate? To some, this Reddit situation was a triumph of David over Goliath, as they've said, the small investor with the renewed power of social media and fintech, beating the institutional investor, the small guy beating the big guy. So we have a hyper network public, as you know, over the past decade. We have the empowerment of the individual through social media and fintech. And with the industrial age hierarchical information structures being less and less relevant, the implications are vast, from the Arab Spring to Trump to even the stock markets now. So that's the philosophical debate. The GameStop events also opened up a more technical question, such as what is behind some of these fintech platforms, and the speakers can opine on that. What do I mean by that? What is behind the interface of some of these platforms? How does the plumbing work? And I'm referring specifically here to the payment for order flow question, whoever followed it, whereby fintech brokers such as Robinhood sold their customers' orders to market-making firms, and that is how their services are free of charge to retail investors. Now, it sounds bad, but it isn't necessarily. The point here is that fintech is democratizing access to financial services, empowering individuals in an unprecedented fashion, but it does point to the question, do we really understand what the plumbing behind fintech is? And with that, I'm going to stop, and I will start with intros. And perhaps start with Steffen of MoonFair and ask you, to tell us who you are first, what your company does, and what problems it's trying to solve.
Yeah, look, Marcus, thanks so much for the introduction. So my name is Steffen Pauls. I'm founder and CEO of MoonFair. And MoonFair solves an issue that we call democratization of private equity. For those of you who are not that familiar with the asset class private equity, talking about the KKRs, Blackstones, and so on, they go out and fundraise from large institutions money, and then on their behalf, they invest it into companies, long-term investments, 5 to 7 years, try really to employ playbooks and improve the companies and then sell them later for a better price. They use some leverage, so you have the famous leverage effect on it. And the best players in the industry really constantly make 20+% returns IRR on a yearly basis. So a very, very attractive asset class. The problem is for the ordinary or normal investor, it's not accessible. The minimum investments in order to get into these funds is typically 10 million, in certain cases, even 20 million and above. So for a normal private investor, not accessible. And this is exactly what we at Moonfare solve. At Moonfare, it's still a regulated market. This is why it's not open for everyone. It will be at a certain stage, and maybe we discuss later, Marcus, when it comes to democratization and outlook. But for now, depending on the jurisdiction, starting at 50,000 euros, you can invest into private equity in a fully digitalized way and can benefit. You can benefit now from that asset class. And that's really the revolution or innovation that we brought to bear.
Victor, please tell us a few words of who you are, what your company does, problem it's trying to solve.
Yeah, hi everyone. Thank you, Marco. Yeah, my name is Victor. I'm the founder and CEO of Plum. I guess we started Plum like 4 years ago now, and the idea is basically how can people, like the mass market, have more money with less effort. And the way we do this is that people can connect their bank account to us, and based on the data that we see in the bank account, we start doing a few things. The first thing is that we start saving money for you automatically once every week, right? You start saving money. Then you can choose to invest that money into a selection of funds, right? We have theme-based funds and risk-based funds. And then finally, we also look at like kind of where you spend your money and start with like large bills, like your utility bill, if you have loans, your credit cards, and we find cheaper alternatives for those asset classes. So all in all, we think if we do this well, people can have like 20% more money over their lifetime because of the effect of compounding. But it's also like kind of part of our mission from when I started the business to kind of bring to the mass market better asset classes or better investment options at very low prices, and then so they can benefit from like kind of the ongoing cumulative and compounding effect of investing, you know, small amounts from an early level. So yeah, that's me. I used to be a trader and I used to be an early employee of TransferWise, and yeah, now doing Plum.
It's great. Paolo?
Thank you, Marcus, and good evening, everybody. So, Paolo Galvani, I'm the co-founder and I'm the chairman of Moneyfarm. Moneyfarm is the third of the fintech of tonight. We are effectively defined as a digital wealth manager. In two words, what does it mean? It means that so when we started the company, and my former job was in banking as well. So when we started the company, the idea was really to try to solve a problem that I perceive it's still there for most of the small and medium-sized investor, which is somewhat this mismatching between what people looks when they have 10,000, 20,000, 50,000 euro to invest, and what they find when they go to the market to look for an investment. So usually the small to medium-sized investor, when he has this money to invest, they look for some advice. So someone who can help them in order to invest in a smart and low cost way and transparent way the money. On the other side, the offers tend to be very much skewed towards selling a product instead of selling an advisory. So you find plenty of situation, not only in Italy, but across Europe, in where people end up having products that are not suited for what they need. And they are basically investing in solutions that are not really fulfilling their appetite for risk and their ambition in terms of return. So in a nutshell, this is what we're doing. We're helping people to invest their money. We're using ETF and portfolio of ETF, and we manage this portfolio accordingly to the risk appetite and to the market performance. So we are effectively a wealth manager using technology to deploy advice to small and medium clients.
Great, thank you very much. So before we jump into fintech, democratizing access, financial services, and the future of that, I'd like to ask each one of you to tell us what you think about the Gamestop saga. What were in your view, the key topics, issues in what happened in your mind? Maybe with Steffen, we can start again.
No, of course, Marcus. And look, you mentioned this comparison with David and Goliath, and I think it's a bit misleading to use that picture. I know it was in the press and it's out there, so it's not from you. Don't take it personally, because that fight really was limited like to two parties. But what has happened here is that some Davids lost money. It's not only the institutional side, the retail side lost money, or some of them. And the other thing is that people forget in the entire story, and it's very, the image is great with David and Goliath, but behind, people have to understand that behind the bad institutional money, there is money from pension funds. And this is the money from the policeman or from the teacher. So what has happened, and one of the funds has lost, I think, 3 billion or so in this funny game, is that this is a severe loss for people that stand behind the system, have not been part of that fight, but now the money is gone. And the second damage, and this is really something that goes beyond just here, the GameStop thing, is the trust issue that comes associated. And this is bad. For everyone is it bad. Why is it so bad? Because all markets, whether private markets or public markets, are built on trust. You're trusting the system, you're trusting, that the markets are functioning. And that trust, got a damage. And this can only be negative for public markets, which are now opening up, and more people are using them also from the retail side to generate wealth. So overall, a story which is, everything else but a success story for no one.
Got it. Yeah. Thank you. Thank you, Steffen. Victor?
Victor, you're on mute.
I think you're on mute, Victor.
Sorry, guys. Yeah, sorry. Thank you. So I think for me, the whole GameStop thing had like one thing that was kind of very interesting that's also happening clearly as the stock market is in like a very independently bull run, right? Like companies like Tesla are at the moon, and basically tech stocks are at the moon, and a lot of these, let's say Robinhood, the tech stock that enabled a lot of these players to participate. There's also a company that's going to IPO, right? But I think what's interesting, because I used to be a trader as well, is that you've introduced this new player to the game, right? And I find there's investing and there's trading, right? And trading tends to be a bit of a game, right? Because I think it's short term, and sometimes the net result is zero. But I think what's interesting is that it's introduced this new player, the retail customer, and I think I agree with some of the stuff that Steffen said 100%. But I think I believe that introducing a new player can bring a different kind of balance to how the markets operate, right? And I think it's just making the whole system a lot more complex, right? And putting a different, let's call it not check, but a different challenge that someone has to calculate whenever they're taking actions in the markets. But I think in the long run, the question really is is this better for the retail investor? Will people be better off? And I think this is the question. Access allows things like GameStop to happen, but I worry as well, at Plum, right? We will give people access, more visibility to their pension, right? To be able to it's limited, but what happens when you give more access to people to things that they weren't allowed? And yes, everyone sees that guy that who mentioned went from 48,000 to 40 million or whatever, and they're like, okay, let me replicate this, and some people would lose money. So I think there's a combination of things happening that will we be better off, right? Because we have more access, right? I want to believe that people can learn from this access and make better financial decisions over the long run. And the second thing, I think it's just interesting from a market, kind of game theoretical thing. If you're a participant in the market, now you have to take into account another player that didn't exist before, right? These people that can trade for free via Robinhood. So yeah, I think change is good. So I'm kind of intrigued by what's happened, I'd say.
Yeah. Thank you, Paolo.
I'm in line with both Steffen and Victor. Probably two other topics were more general, which is I think one of the things that strikes me a lot when we're talking about money and investing is after all these years is still the same, the confusion between trading and investing, right? Which are two very different games. And people, unfortunately, tend to confuse the fact that putting money into a financial instrument could be very, very different depending on how do you do it and the logic behind it and so forth. And unfortunately, investing money means basically having some clear idea on the amount of risk, the time horizon, a series of questions that are key in order to fulfill what you are expecting to make. And usually these are the money that should somewhat support your long-term aspiration, being a pension or a university or for your kids or whatever. The trading story is something that use more or less the same financial tools, but has a complete different approach, which basically says, I'm entering into the market and I'm somewhat demonstrated that I'm smarter than you, given that is a net zero sum. So if I buy, you sell, and I know how to do it to make it work. Now, there would be plenty of information that you requires in order to be effectively more smarter than the rest of the crew. But effectively, what numbers suggest, especially for the small retail, for the retail investor, is that the large majority of people that goes into the trading space lose their money, right? So if you look at the percentage of gainer versus loser in the small retail place, well, I think I'm not very far in saying that 90% lose versus the 10% that wins, if you look at more or less statistics on the trading platform. So again, access is important, but you should be, and this is where I struggle, you should be aware of their different role, because there's plenty of good reason of thinking that there are some stocks or some situation in which you are happy to invest on and put some money at work, but it should be taken separate from a long-term horizon or perspective on how you should preserve and increase your capital, because you don't want to bet your pension on something which you are not in control in a rational way. And so this is kind of the first thoughts. The second one, and I don't want to steal too much time, the second one is somewhat, I don't see, I mean, the overall situation, if you want, is not very different to plenty of other speculative situations in which we have seen in the past using different tools on different situations. I mean, Wolf of Wall Street of DiCaprio was somewhat representing, the penny stock market in the early 80s or 90s, and the story wasn't very different at the end. What makes this story different, at least from myself, is two things. One is what you said. So technology and fintech has allowed people to enter into the game at a different level with a different interaction. And second, which is probably even more interesting, is the role of the community, right? The digital community, the Reddit of the case. So, the concept of market manipulation until today, i.e. passing some information in order to make shares going somewhere, is very well known, and all the regulatory body across the world knows how to handle, but with traditional player. When you're entering into the space of social network, which at the end of the day sells their concept as content rather than editor, then you are adding a new player that, as we know, these things has applied to politics and to a lot of different things. Now, this is the perfect example in finance, right? So what is the role? Who's responsible for what? And I think it's opened up a whole new interesting consideration in respect of how to regulate and to make more sound a market. I'm not saying it's wrong or is good. It's a more a question, more of philosophical role of the player within a financial markets at the end.
Yeah, no, absolutely. It's new territory for regulators. It's very, from what I was hearing from somebody that knows the SEC well, it's very hard to go after people, especially if there's a large group of retail in a forum. Then there's also the issue of, it's transparent in many ways, right? There's no behind the room dealings or anything of that sort to manipulate stocks. But I hear you, it's all like now a question, and you see a debate around this now that you weren't hearing before, I don't think. Yeah. So I think that's great on GameStop, but because this is much broader than GameStop, I thought that perhaps we just go a little bit more into the future of fintech and what you all are trying to do. You know, we did say that fintech is democratizing access to wealth management, other financial services, and that's what you are doing. How far have we gone down this path at this point, you think? So, and where will we be, let's say, in the next 5 years? So, or put it otherwise, what else needs to happen for the small investor to be fully empowered to compete head to head with some of these large, sophisticated investors? When I mean compete, I don't mean it in a nasty way like GameStop. I mean to be able to succeed in their investing as much as a sophisticated large investor with many resources.
So maybe it's something I wanted. I'll start if that's okay. I think one thing that I feel is like, what is fintech, right? For me, fintech has many definitions, but it's a drive to lower costs and fees, right? So I think, like, if you think, like, you know, I started TransferWise. I joined TransferWise because when I was at Morgan Stanley, I could trade at mid FX, and then I went out in the world and they were like, it's 5% or 10%, right? And then TransferWise is like, we're going to do it for free. They ended up doing it for 0.5% and lower. So I think a lot of what fintech is doing is bringing technology to lower fees, right? And if you think about what's happening with the trading platforms, right? When I was in college in the US, you could trade for $12 a trade, right? And now it's free, right? And you have payment for order flow, which enables that. So I think overall, the point of technology in financial services for me is, and what does access mean? Access means lowering either the amount that you need to invest, like in the case of what Moonfare said, like it's 10 million, now it's 50,000, right? And it's also the fees to do certain transactions, right? And I think what's happening is that as you lower the barriers because of technology, things are cheaper. There's technology, it scales, right? And you lower the cost, more people can play, right? And what we've seen with trading is that by lowering the cost, you introduce new players, right? And then the market dynamic changes, right? But I think the role of fintech is to lower the costs, and there will be, like, you know, unavoidable things that happen, and then the regulator may step in, right? And I think for me, it's this question, right? Especially when we talk about investing and the facts that, like, you know, as Paolo mentioned, that, like, you know, yes, it's on the CFD's website. They have to write that 78% chance that you will lose money, right? And effectively, they're like a casino, right? So the question is, I think from a society perspective, right? Access is good, right? We're all here to give more access at lower costs and more transparency. The question is, how do people learn, right? Like, how do they all lose their money, right? Or do they lose £100 on a Robinhood or a CFD, right? They lose £100 that they play with, and they realize, I can't beat the market, so let me take a long-term approach to investing, right? So I think these are the dynamics that are at play, and fintech's job are to lower the cost and give more access, but there will become a social responsibility element, right, as to what happens when you give that access. And I think for me, sorry, I'm mumbling, but like something that I thought was quite interesting, because I studied behavioral economics, right, a bit. And the thing that happened before this whole GameStop event, right, was that Robinhood was fined by Boston, right, by Massachusetts, for basically gamifying the experience, right, in a way that made people make bad financial decisions, right, because of the way they do not fireworks, but that little like explosion thing, right? And they have this like top list of what people have invested. And I think that is the level that we've reached, right, where financial services, and this is the interesting part, right, the way you build your product can influence decisions, right? That's all. Financial companies are A/B testing all the time, right? And they're optimizing to grow their user base, to grow the revenue, to grow engagement. And it's interesting that the regulator stepping in and saying, hey, we think the way you're optimizing engagement, right, is potentially having a harmful effect on the end customer result, right? So they're stepping in and protecting the consumer. So it's an interesting dynamic, right? Because you're saying, can people protect themselves, or do they need someone else to kind of even tell the companies how to design their product to reduce engagement and not have negative results? So I think that's, I don't know, those are my thoughts on the topic that I find quite interesting, and I don't have the answers for in a way.
Sure. Perhaps Steffen, any thoughts here on you know, what fintech has done so far, what it can do in the future, and what some of the trade-offs that Victor mentioned here in terms of the way that we will see a kind of along the way would be?
Yeah, look, many of the developments that we are seeing so far, are really focused on the public markets. Yeah? But if you take a broader perspective or more from a professional investor and take a look into their portfolios, you will figure out that the best investors on earth, and I want to quote here, for instance, the example of the Yale endowment, which is always in the literature. And if you take a look in terms of their asset allocation, you will figure out that 50%, more than 50% is in private markets, not in public markets. And there, in private markets, an unprecedented value creation is happening. Just pointing out, and people are familiar, if you're following the tech space, what happened, Uber pre-IPO, Palantir pre-IPO valuations in the billions. More and more pools of capitals flowing into the hands of the Sequoias and Founders Fund of this world. They keep the private assets much longer. Why is that? Because they have learned from Amazon and Google and Facebook and other examples that they've brought the companies to the public market far too early. They left too much value creation, so to say, out of their hands and left it to the public markets. This is going to change. And this is what we are seeing the past 10 years. Holding periods go up and up. So more and more of private market value creation is happening, but most of the people are being left out. I said Yale endowment, and by the way, the average of professional investors is 25% in private equity, and the private individuals, they have less than 2%. And this is something that I think is very, very dangerous for several reasons. You see this Gini coefficient is going up and up, is widening, because institutional money is becoming more and more professional money, and rich people who can play that asset class with real estate, with private equity investments, and so on, they are getting richer and richer. And there is, a need also from a governmental and regulatory standpoint to open up these markets. Bond markets are gone. Public markets in some ways is still a very important source of wealth creation, but we are volatile, sometimes not working as we've learned, and also pretty much at high valuations. A lot of inflation is happening there. So we have to open up as a society private markets to the, call it, ordinary individual. And there the regulation is, in my view, really totally misplaced. It's wrong. Why? How can it be that a poor private individual can play highly technical instruments like options and short selling and so on in the public markets? Probably most people don't understand. Black Scholes, I never understood this formula, and I guess many people don't understand these instruments either. But a well-diversified portfolio of super healthy companies of a KKR or Blackstone is not accessible for regulatory reasons. Doesn't make any sense. So what is needed, to your question, and then I want to sum up there, it's deregulation, and I'm sure it's going to come. The SEC understands it, the FINMA understands it in Switzerland, the BaFin in Germany. They know this, that they have to open up the value creation and have ordinary people participate in it. So regulation. The second thing that is needed, which is associated in a way, it's liquidity. You have to create liquidity for non-liquid assets. This is exactly why Moonfare has opened up a digital secondary market trading platform. So you can trade, you can get out of your commitment in a private equity fund, which is typically, locked in for 10 years. That is the mechanism. And blockchain, if we talk about it, might be another accelerator there. And then the third thing that I see is, the tradability in private markets, not only liquidity, but also, transfer of ownership has to be much easier. It is not like with a stock where you really literally in a second can trade it. But again, blockchain will open up that market. And I can see a world, maybe not in 5 years' time, but in 7 years' time, where each of us has a little wallet and you have all assets, not only, private equity and stocks, but really art or, old cars or everything that is in the value creation set of private markets, that you have a small wallet and you have a little bit of an art because it's atomized and you have, tokens. You have a little bit of old cars because it's a good asset class, maybe wine. Some people are dealing with that as well. And then, of course, public markets. So at the end, for me, the end game, so to say, is really that all people, as it happened in the stock markets already, can participate in all asset classes, including the private ones.
That's great. Thank you. But Paolo, any thoughts?
Yeah, I think it's a very, I think that if I have to look at, what fintech has done and what is going to do, a bit more kind of from a bit of a outside, I think the fintech has more or less followed all the disruption sort of industry, with the same kind of approach for a lot of different other business in respect of building solution and products that otherwise wouldn't have been available to people. So fintech has provided, product that weren't there before, lower cost, higher access to information, a lot of transparency. So all things that basically you can now recognize in a lot of different industries, and through technology has been possible to deliver. And so, for instance, in our case, we are offering a solution for investment of a portfolio of differentiated ETF of a lot of different asset class with an approach that is very institutional in the way in which you are managing money, but for a guy which has 10,000 euro to invest, right? It wasn't possible until a few years ago. Now, like all the other industry, we are also coming to the same challenge of what technology can and cannot do. And I'll just give you an example. So, reducing the cost down to zero. Well, okay, so that sounds very interesting, right? And it becomes more and more, appealing from a client. But then comes the other question. So if the cost is down to zero, so which is the products, where the revenues are coming from? No, and I'm coming back to your point of the payment for order flow, in other words, right? So you effectively are taking a service, but in fact, you don't really realize that at the end of the day, there are some gain based on your usage of the platform itself, no? So, well, that's kind of start to become a bit more kind of opaque in a sense, because yes, it should have been transparent. You are giving you a lot of access to the market, but at the end of the day, you find yourself that at the end of the day, you really don't understand the full logic behind, no, the overall mechanics. So all to say that I think that for the fintechs to step up, it's probably needed a couple of things. First of all, of course, increasing in brand recognition. We are playing against the large player, big pocket investors, been in the market for long times, and position yourself against the large guys takes time and recognition. So you need to be, committed and long-term focused as company as well. And I also think that you need to have a clear and precise mission and DNA embedded in what you are doing, because this will help you to somewhat take the right decision when the moment will come, right? And so in order to be always transparent and always very dedicated to what was the original objective that you position yourself when you build these things. So it's a question of value, and it's a question of position in the market. But I'm 100% convinced. I mean, there's no doubt that the revolution in financial service that we have seen in the last few years, well, was only possible because, a bunch of people tried to basically create alternatives to a model that was very, very defensive and didn't allow much innovation until a few years ago. I mean, let's not forget, no?
Perhaps this is a perfect segue to blockchain and crypto, which is a topic that I must say out front is something that I've been studying for quite a while, and it's very dear to me. And many people disagree with me, but crypto and blockchain, it's trying to recreate the entire financial plumbing. Think of DeFi. I'm sure you're aware of DeFi what is being built on Ethereum. It's trying to recreate the entire financial plumbing in a different way, in their view, in a much more efficient, open way. What I want to ask you about, we know we're very early in blockchain and crypto right now, but what do you think of this space and its potential? And how do you think it could get married down the road with fintech? Could it, or is it going to live in parallel forever? And would you include crypto in your platforms down the road? Perhaps, I don't know who wants to take this first.
Well, am I on mute? No.
No.
I can go a bit. It's a huge question. I haven't concluded. We didn't add crypto to Plum for a while. We resisted because we felt it was a speculative asset, and we were trying to make a decision, not on behalf of our customers, but we were trying to, let's say, protect them from that, given that we care about their long-term, money, even though we're not an advisor, right? But like, I guess what's happened recently, it feels like it's an asset class, right? And kind of, I guess what we're trying to do is kind of what Steffen kind of mentioned, right? Like through Plum, you should be able to hold a bunch of different asset classes. That means that you have a diversified portfolio. So as a portfolio approach, right, we should enable our customers to have access to that asset class, right? The second thing that I think, again, I don't know enough about it, and Marcos, I'm going to call you at some point in the next few days, but like, what's interesting happening on in the whole crypto space is these like lending products, right? That you basically have no asset class volatility, but you're lending your money that's being used, which is what banks do, right? Which is being used, I don't know, for leverage and a bunch of other stuff. And you're being paid like 8% or 20% over a year, right? There's a risk there that I don't understand, right? But I guess maybe it's not for this discussion, but I guess as a savings platform, right? You wonder, like, in the future, is there a different way for consumers to kind of have this return on their money in a less volatile manner, right? So I think for us, from that perspective, we look at them as like asset classes, right? And we look at them as alternatives to maybe save, right? And it's something that we need to explore because we want to enable our customers to have access to, I don't know, the best in class asset class. The last thing I want to say, which is, again, I think is like what Steffen said, that everyone will, through blockchain, everything will be digitalized and everyone will hold a little piece of everything, right? And like, I always thought, why can't I have the Yale portfolio, right? It seems to perform well, right? But I don't have access to it, but will I have it? And as you were talking, Steffen, I was thinking like, well, the only way for me, and then you mentioned issues of liquidity, right? But if we like zoom out, right? If everyone has the same portfolio in the world, right? If everything is liquid and everything's accessible and everyone can have a little piece of everything, right? Everyone should have, in a way, it's a more, again, it gets into a philosophical question. Everyone should have the same performance, right? And it almost got me thinking, like, you could see this completely reverse thing, because the only way I could have access to completely private markets if there was a public pension, which we all know probably won't do a good job, but you kind of get back to that. Like, if everyone wants a world portfolio of like every asset in the world, you do it through a very not centralized, but you need access to all of these asset classes. I don't know. I don't have a solution, but I think it's interesting things, right? Because do we all revert to having the exact same thing, which is a bit of everything? And how do we get there? And yeah, is that the equilibrium that we get to?
Sure. Steffen, any thoughts on crypto and blockchain? Maybe not necessarily as assets in your platform, although I would argue that Ethereum is really a venture capital investment in my mind. Forget the volatility and the high prices. What do you see blockchain and crypto developing into, and how could it marry with a current fintech landscape, if at all?
Yeah, Marcos, look, I'm only two lessons I've learned at KKR, and this is the philosophy that drives me also today with Moonfare. I have to understand things before I can invest into them. And even more so if I'm offering this to the broader public as I'm doing it with private equity. That's an asset class I fully understand. I'm sure there is something behind this crypto thing, but I'm not as much enough of an expert to really judge on it. And the second thing, what I've learned at KKR is be extremely careful with businesses in general that might be or might not be regulated in the future. And that is something that is for me the big unknown on crypto, all currencies, because if I would be the Fed or the Deutsche Bundesbank or the European Central Bank, do I really want to be a currency that is out there that I can't control, also from a governmental perspective, yeah, and can't control not only, you know, as a currency, but also in terms of who's possessing it, who is the owner of it. So the entire know your customer thing, where you know the regulation has invested so much money in anti-money laundering, etc. So I'm a bit skeptical, but that's my personal view, whether, you know, this is really becoming a long-term asset class or not, but I don't know. What I know is that the underlying technology is changing a lot, and it does already. In my space, and again, in less regulated places such as Singapore, and it's great, there are companies out there that are doing the securitization, tokenization of real assets, yeah, and private assets in that case. So now suddenly, you know, people really can trade, and it's backed, by the way, this company by a Singapore Stock Exchange. They can trade tokens in a regulated way, yeah, and the underlying technology allows it because of the, you know, one source of truth, transfer of ownership, all the various reasons that make this a great technology. I believe blockchain is probably, as a technology, one of the largest catalysts for the theme that we are discussing here, which is democratization of assets or investing.
Yeah, and you're thinking much more of tokenized real assets.
Correct.
As the killer use case.
Yeah.
And then Paolo, just maybe some thoughts from you as well. You don't have to. I mean, the crypto blockchain is a bonus question.
No, absolutely, and I admit my ignorance as well on the topic. Although, you know, few opinions on my side. I'm in line with what Steffen was saying. So today we are not offering Bitcoin or crypto to our client. There's two main reasons, I would say, if I have to adapt. The first one is a technical one. I'm still struggling to understand the dynamics of certain events, the halving concept, for instance, how this is replicating, what's the dynamic behind the price movement. So the overall technicality of a limited amount of goods at the end of the day, of values, right, in a market, which is a fascinating concept, and we have never had this kind of situation before, let's say. And the second is very much the regulation body, because at the end of the day, the scope of the Bitcoin and in general these values is exactly to find an alternative to a traditional system, in a sense, right, a regulated system. And so it's natural to expect a clash a day or some days between what is the alternative and what is the existing system, because it's the reason, one of the reasons why the assets is there by definition, no? So how is gonna end up, and the amount of volatility generated in that respect is still something a bit too high to me to be considered. Having said that, just like to wrap it, I think I'm positive overall. So I do think that this is somewhat live with an alternative in a medium term that is going to here to stay. We are probably not there yet in respect of what is going to be its feature and so forth, but the concept of a digital currency or a digital alternatives and so forth, I think is here to stay. It's simply a bit too early for the reason I mentioned, for at least in the way in which I perceive it, to insert it in a traditional portfolio. But I'm very curious to see how it develops.
Absolutely, that's great. Perhaps I'll finish with one question. Now, unrelated to crypto and going back to fintech. You are giving the small investor, the individual, more power through your platforms to invest and to make money. But what would you caution them most on? And let me, for example, take Moonfare and Steffen. You know, very wealthy people, you mentioned very wealthy people have had an unfair advantage in this game of investing money. They've have, you know, armies of lawyers that look through the private equity paperwork. They tell them, you know, armies of advisors telling them, you know, how to structure things. Now, would you, what for the individual investor, who's going to fill in that gap? I mean, I know you're filling it to a certain extent, but are there any loose ends at this point? And would you caution some of these folks against pitfalls? It's a hard question, I know.
It is a hard one, and my spontaneous answer would be the most important thing really is education. So I said it earlier, you really only should invest in stuff that you understand. And if you don't understand private equity, or you don't get the right level of content information to so to say make yourself really familiar with the asset class, you should take your fingers off. The second aspect is probably if you don't feel comfortable to get there on your own, and many of the instruments that are out there are really, as I said earlier, options and so on, very difficult to understand, then you should get the right hand-holding or expertise. And this is, and I know this speaks a little bit against this group, but I'm not a big believer in some people stating fintech is taking over the ordinary banks. To some extent they do. But there is still a need in cases for guidance, personal advice. It could be, digital advice. One thing that we will offer on the MoonFair platform, which is, I think, an interesting aspect, is that basically the community, the smartness and collective intelligence of the community, so the investors on the MoonFair platform, takes over the role of the advisors. We take, our smartest people, so to say, and in this case, people from the industry who know exactly what they are doing. So to say, the best traders would be on the public market side, a little bit like Vico Portfolio and all these, where you can emulate people and follow people that have proven to be smart investors. And we will do the same, so that people then can see which funds do they pick, what is their asset allocation, what's the fund's composition, and so on. So that's another thing. And then the third that I would recommend people is really be diversified. And the entire Gamestop thing is another example. If you put, of course, your money into one stock and that's it, and you're not diversified, you might lose everything. And this old Markowitz rule, uncorrelated assets, in our case, invest across vintages, so various years, managers, geographies, currencies, asset classes. This is really that would be my strong recommendation for everyone who wants to play, for instance, my asset class, private equity.
Thank you, Steffen. Paolo, Victor, who wants to go next?
I can do it. I think it's somewhat very I would say very direct on my side. So in other words, I mean, I completely agree with the education concept, right? So we spend some time talking about the difference between trading and investing. So make people understand the logic behind and the mechanics behind investing money for real objective and medium-term horizon and so forth is part of an education process, right? It's amazing how difficult it is to take your money and save it, and so all the efforts, work, and so forth, and then the lightness in which most of the people invested those very suffered money into something they don't know, they don't spend enough time, because at the end of the day, the process of investing is not the most enjoyable moments of your week, right? After a week of work in the office, it's not a Saturday morning you wake up and think, well, now I'm going to spend a couple of hours in thinking about how to invest my money. No, usually it's kind of, my cousin said, or the friend of my friend said, and things like that, which if you think it's somewhat really, it's terrible, right? You spend more time in choosing the model of your phone rather than putting your money in the best way possible to have a decent pension. So education counts a lot, and helping people to realize that in order to do this properly, it requires really kind of methodology in a sense, and not being overwhelmed by emotion as market moves. These are the things that are the most complicated one. To give you an example, and then I pass it to Victor. So for instance, if client comes to us and asks to invest the money for a period of 6 months or 1 year, we're simply saying we're not accepting that money, simply because it doesn't make sense for what we're doing to have money for 6 months. the volatility of the tools would be too high or too low, or completely inefficient in respect of objective that takes way longer, and in a structure completely different. So that's where it becomes the challenge, I think, for everybody. And that's why I completely agree. At the end of the day, advisory, consultancy, digital consultancy, it's the only way to go, right? Because that's how it works.
Thank you very much, Victor. Maybe we finish with you, and then I think we're wrapping up because we're hitting the hour, and we need to move on to the next, I think, event after.
Thank you. I think the one thing that we should all say here is that GameStop is up 86% currently today.
I haven't followed. Interesting. I wonder whether is it again the Wall Street Bets group, or another group pushing it up? I mean,
someone must be doing something, but we're all bad investors because we didn't figure that out and put our money in GameStop and just doubled it today. But I think to that effect, I guess the problem that I feel we need to solve is that all of us here are kind of investment professionals, right? And we're thinking about alpha and allocation and where should you put your money and stuff like that. And I think the problem that we're trying to solve starts, and this is the problem I was trying to solve for myself because I was a trader, but I wasn't really managing my money well. And I think one of the biggest problems we have is people are just not allocating or not saving or not investing, right? For me, I almost feel okay, you can adjust your alpha. You can adjust your alpha a lot, right? I kind of get it, but the biggest problem is that people are not putting money into investment. They're not putting money consistently to the side, right? And I think, a huge driving force of returns is how long are you invested, right? Yes, it makes a difference if it's 10 or if it's 12%, right? But if we all assume that we're not geniuses and we can't, outperform by whatever, and then that's the whole philosophy of index investing, etc., right? I think the biggest thing that we need to do, and what Plum is doing and what the industry needs to do is and kind of goes down to the democratization, is get people putting money in investments in small amounts, right? Very early on, so they can see the benefits, right? And then asset allocation is a question for later, right? If you have the choice, if you're lucky enough, which I think is a very small percentage of people, right, that can choose between private equity and real estate, etc., that's reserved for so few people. But the major problem we see, and I think it's a big problem in the UK and Europe, right? People are so underinvested in Europe compared to the US, right? And what they're leaving on the table is the fact that by the stupidest index on earth, right, you're doing better, right? Forget about optimizing performance. So I think what I hope will change, and with all of this GameStop stuff, is that people are understanding that there's this thing out there that moves like crazy and you can make money, right? And hopefully with interest rates at zero and negative in Europe, that's finally a push to say, well, there's nowhere I can put my money, so I need to find something that I can put my money in, right? And I think that's what might change finance in a way, because then what becomes a savings account, right? I think it's okay until it's zero. Once it goes negative, you get a bit annoyed, right? It's a bit annoying. I'm not going to put my money and get negative. And maybe that's the big push to investing, which it definitely, hopefully does not mean people buying GameStop, right? But it hopefully means that people are putting their money at least somewhere, right? And then they can optimize up the risk curve as they choose to. So I think that's what will change. People will have a lot more allocation to assets that move in a certain direction. Yeah.
That's great. I think this was a very, very good discussion, went into many different areas, and I think we're going to wrap it up now. It was great. Thank you all so much.
Thank you so much. Appreciate it.
And you, Marco.
Thank you. Have a good evening, all of you. Thank you.
Thank you.
Thank you.
Bye, everyone.
Thank you very much.